Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, Scott shares his winding path from starting a hedge fund right out of the University of Chicago to pivoting to a quantitative research position at Morningstar. Learn why he jumped to Schwab and eventually earned his title of VP of Risk and Quantitative Analysis. We chat about his transitions, about the fast-growing passive ETF trend in the asset management industry, and much more. Enjoy. All right, Scott, welcome to the Wall Street Oasis podcast.
Yeah, thanks for having me. I'm happy to join.
So it'd be awesome if you could just give the listeners a short summary of your bio.
Yeah, sure. I graduated, from the University of Chicago. Quite a while ago, probably almost 10 years ago. But I studied with a background in economics and statistics. During that time, actually was, pretty heavy into fundamental investing, equity research, investing clubs, but also actually got into options trading and developed all volatility strategies through my time in college. Probably a little bit too much. But I did that for a little bit of time. Was trying to go to the hedge fund route, so I ran a hedge fund, and then did that for half a year to a year after school. Decided I was going to go back to the workforce. Then I kind of worked at Morningstar for 3 years. I worked kind of in their buy side investment management arm, focusing on tactical and strategic asset allocation. So doing a lot of top down equity valuation work, as well as bottoms up, valuing asset classes and the long-term expected returns and capital market expectations. So after, roughly 3 years of doing that at Morningstar, I moved to Schwab, more on the quantitative, research investment risk side.
Is that like it's internal corporate, like you're running risk like on the is it more like an internal service for Schwab, or was it just
Yeah, it's basically the investment risk team or the quantitative research team. So Schwab they have a lot of quantitative. They have actually 8 quantitative active strategies, 5 of which are domestic. Large.
I interrupted your bio. Sorry, you can finish your bio, and we'll get there. We'll go back.
Yeah, no worries. But yeah, it was quite a small team, and obviously Schwab is more known for their brokerage. But they do have a lot of their own mutual funds and products, right? They're also really well known in the retirement space. So I cover the quantitative strategies, work with portfolio managers, did a lot of quantitative research, market research, also valuation work too, worked with a lot of risk models, and really providing recommendations for portfolio managers on how to position their portfolios. So covered both active fundamental and active systematic strategies. And then at the same time, because Schwab was quite heavy in kind of their retirement business, they had a lot of target date funds, multi-asset portfolios, where we would look to hire managers to essentially be sub-advised within like the active sleeves, right? So if we have like a target date fund, we want to hire large cap growth manager. My job would be to interview a lot of the top fund managers to see if I want to hire them, fire them, put them on review. So I interacted with all of the top buy side funds and talk to portfolio managers on a monthly and quarterly basis, including like BlackRock at the time, ATR, Dimensional Fund Advisors, Dodge and Cox, Wellington.
They're trying to convince you to give them capital as an outlet,
right?
Basically,
exactly.
For that. Got it. Mm-hmm. Okay, cool. Okay,
and then after that, for roughly 3 years, then I kind of moved to BlackRock in a very similar type of quantitative risk role. Except now I'm moving more towards the ETF space. So now I kind of manage a team covering the equity iShares book, roughly worth $2 trillion. And it's obviously very, very different now, right? BlackRock, obviously much larger firm. And equity iShares book, there's like over 1,000 funds, both institutional and on the retail side. And so the type of work is very different. Back at Schwab, I could spend a day on each fund, deep diving into the fund, looking at the portfolio positioning, doing market research. But at BlackRock, it gets very different because we're managing so many funds with kind of a smaller team relatively for how many funds we have to manage. We have to think about scale, right? Yeah. How to develop a risk infrastructure, how to do quantitative research at scale to manage all of these products. Where I come in the morning, create this risk infrastructure that maybe flags like 10 to 15 funds, like, hey, you got to take a look at these because they're breaching our risk ranges. So what that comes with is decomposing the risk of every single fund into each individual components to come up with what is the expected risk level we would expect out of each fund and whether they're performing within that range. And also a lot of my work goes into product development too, right? BlackRock is now developing a lot of more exotic products. For example, a lot of the buy right, ETFs that recently launched earlier in the year, they're essentially, covered call strategies on fixed income ETFs like HYG, high yield, iShares. Now there's a HYGW, a strategy where we write covered call options on those. And a lot of that work goes into developing the benchmark and the benchmark methodology, right? Because after the product launches, all we do is we track the product, but a lot of the kind of the alpha research that goes into developing these products starts really upstream. So I'm really working with like index providers, back testing strategies, figuring out how is this product going to trade? What is the strikes of the options? What are the expirations going to look like? When do we roll them? And obviously take into account liquidity of these options, right? You may not always want to roll on the last day or 2 days before. So a lot of like alpha type of research goes into passive products. It's not just as simple as, you just match the benchmark, focus on rebalancing. There's a lot of active type research that goes into these.
Like the mechanics, setting up the mechanics. Right. That's cool.
Exactly. So developing new strategies, yeah.
I'd love to dive into that a little bit more later, but let's go back all the way to your college days at Chicago, Chicago. So, your econ minor stats, are you thinking finance all the way? You said something about a hedge fund. Did you try to start a hedge fund out of school? Is that what I heard?
I did. So I was actually, I was really interested in finance, like pretty much on an early age. I was into fundamental investing, stock picking, like DCF work, your typical fundamental, stock junkie type of stuff, and doing the investment clubs. And then I had a couple of friends
was your family in that? How did you come across it initially?
That's a good question. Actually, my dad, he's an electrical engineer, but he's always had a passion in finance. And he just told me when I was young, he just gave me a few $1,000s. He's like, hey, go buy some stocks. Let's talk about it. At this point, I was like maybe 10 or 11 years old. I had no idea what I was getting myself into. I think during this time, I was around the financial crisis. So it was a terrible time to start. Yeah. But also kind of a good way, right? Kind of great lessons learned. But he always told me he would have gone to finance, if he were to redo his career. And he just told me whether you choose to be in finance or not, it's always important to be financially literate to understand how to invest your own money. It just happened to be. I loved it. It's something I always wanted to do. So that's why I wanted to major in econ, kind of as that foundational skill to go into the markets.
Cool. So you get there, you're like gung ho. You've been trading now at this point for 4 or 5 years through high school.
Yeah.
You get to Chicago and what's going on through your head?
And then I also just at the time, 10, 20 years ago, equity research was really like the sexy thing to do, right? Stock picking, fundamental investors, you'd have like an army of equity researchers. Each one follows 10 to 12 companies. And obviously times have changed, since then and even before then. And I kind of got bored of equity research in a lot of ways because I've been in it for so long. And I just want to try something new. I was young, nimble. And at the time, I had a couple friends. One of my close friends from high school, he was a stats major at Berkeley. And he worked at some trading firms, internships. And he just approached me. He was like, hey, I want to work on something together, in college. I was backtesting trading strategy, volatility strategies. And I think there's a lot of potential arbitrage opportunities in this space. And that's what really got me into it. Started reading books on options trading, really got, into kind of derivatives trading, developing strategies. And yeah, I just loved it. I don't know. I loved it more than
do you feel like it was like there actually was arbitrage opportunities, or was it something where at that point, I mean, HFT, high frequency trading, had already kind of started, I think, exploding by that point, right? So did you feel like there was money to be made, or obviously anytime there's an arbitrage that people find it and it closes up, right? So was it something like a repeatable process you guys felt like you could continually to innovate to find money, what was the thought process behind it? Because I think as college students, it's pretty bold to think, we can go up against these multi-billion-dollar hedge funds and find maybe it's because you thought there was smaller markets that just weren't paying attention to, but what were your thoughts around that?
So that's a good question. Obviously, markets are highly efficient, right? My thoughts around it was, hey, within arbitrage, even if you study economic theory, there's always limits to arbitrage for various reasons, right? For trading out of the money, selling put options, if you were to back test it all the way back to the 80s, you notice that there's a consistent variance premium from selling deep out of the money options. You're almost getting compensated for almost being like an insurance company, right? Because you're writing call options, writing put options deep out of the money. And oftentimes those are the most mispriced options. And you're wondering, why is this persistent profit able to be made over time? You would think that it would be arbitraged away. Well, there's probably a number of reasons. Number one is the human aspect of things. The average human is very risk averse. They're willing to pay for that protection. Number two is just like limits to arbitrage regulation wise, potentially, right? You have all these funds out there that are primarily long funds. All the largest asset managers, like fundamental stock picking, they're all like long only, and they have the most assets. And a lot of times they're not obviously allowed to short, right? So a lot of times the best way that these managers can potentially protect against market downturns is by buying out of the money put options a lot of the times.
Yeah.
So there's kind of this uneven
demand and supply.
on demand, exactly, that has been persistent from the early 80s. And actually Warren Buffett has actually talked about it.
And even gotten worse probably as more money is flowed to these passive strategies. Maybe there's some passive strategies that employ this automatically. Who knows?
Mhm.
Like, in terms of just the trillions of dollars chasing like
Right.
similar names and stuff. But yeah, okay.
There's a lot of white papers on it. Like Warren Buffett has actually talked about it. Actually, in his early days investing, he sold a lot of long-term out of the money put options across various expirations on top of his fundamental value investing, right? He's actually talked about it, in his early days. That's actually what he did too, to actually make some side money. So I did a lot of research there. I just like, I totally understand the aspect of there being market efficiencies, but there's also limits to arbitrage. There are definitely opportunities. Like we weren't trying to compete with the high frequency traders, right? Like, we're not aiming to do the strategy. There's no way we're going to be able to beat those guys. Right. But if you can find your niche, find your market, I think there is definitely money to be made.
For sure. So how did it go? So you launched this when with your friends in sophomore year?
I launched. It was roughly like I started maybe like around 2013, reading a lot of books about it. Probably didn't really start actually trading with real money. We did paper strategy first. Didn't start trading with real money until maybe like summer of 2014. Did it for a year and a half. It was great. Like returns are great. Obviously, at the time I just whatever money I had saved up as a college student, I just threw it all into it. It's something I wanted to pursue. And why did I stop? That's probably the next question.
Or not even why did you stop it? Were you doing any other internships during the time? I mean, that was kind of your junior year. Like, did you work at any hedge funds? Were you doing any internships during school, or were you just focused on this?
Actually, I didn't. I was going to junior year summer internship, and I decided, hey, I've got something good going here. I'm going to spend my time in the summer to do this. And I was
money. Also, so you're doing paper strategy. How much money did you actually dump in? Did you $10,000?
Like $15,000-$20,000. Like me and my friend, we both chipped in. Returns are great. Like obviously, we took a lot of risk because we had a huge risk appetite as young kids. We made like 4-5 times our money in like probably a year and a half. Obviously, highly volatile. Sometimes like I'd lose like 30-40% in one day, but that comes with the risk, right? You can adjust that risk level up and down.
Yeah. You had a big enough role to how the poker players, they talk about bankroll, right? Like you never want to be more than like a 200th of your bankroll.
Right, exactly. It's like you're going to be collecting those premiums over time. The biggest thing is risk management. That's the biggest aspect of strategies.
Yeah. It's like you were able to lose 30% in a day and still survive. Like
within like it depends. Like sometimes black swan events, right? It's like you're going to lose money because we can't necessarily predict black swan events, but it's how you manage that risk after it happens. How do you minimize your losses?
Yeah,
because those events are going to happen no matter what. It's really after the fact, after it happens. How are you going to manage your positions? How are you going to close them? How are you going to hedge it? That's where.
So you were having good returns. Year and a half, you made 4 or 5 times your money, or like when you pulled out your money, what did that 15,000 turn into? I guess
turned into almost like 80-90K or something like that.
So
I didn't put any more extra money.
Yeah. Sorry. So what was that thought process of stopping and just going into the workforce? Why not just try to scale this?
I didn't want to stop it. The biggest thing was I learned that in finance, same with any other thing, like the idea is 10%, execution is 90%, right? It becomes really, really difficult when you're a 21-year-old kid going around asking for money, and I have no credibility. All I have is like, hey, I've been trading for 2 years. I have this performance. People can always say, oh, even a broken clock is right twice a day, right? Mm-hmm. So building that track record and building that reputation, you learn that there's a lot more to a hedge fund than just starting a hedge fund than just the returns in itself. Yeah. You have to know people. You have to have, because at the end of the day, if someone's going to invest in me, invest in the fund, they're not investing in the strategy, they're investing in me, a 21-year-old kid. They believe that, I have what it takes to do it. And in my mind, I can always go back to this at a later date. But, I also felt like in order to scale something, I've also just never scaled something at that age in my life. I had no business experience.
Did you feel like in order to execute the strategies successfully, you did need to scale and like in terms of team, in terms of systems,
Right. I did feel like, at some point I want to gain experience in the workforce, whether it's like managerial experience, understanding business operations, understanding business politics, how to raise money, how to present.
What did your friend
Um,
say, your co-founder? Did he want to keep
they
going?
agreed. I mean, we tried. It's just we did a lot. We still did a lot of it on the side while during our full-time jobs. We decided like, you know, we don't have to go that quickly. We could take our time, really, focus on developing other intangible skills, right? Into starting a business, raising a business. It's not as simple as in tech, where if you develop a product and there's nothing out there and the product gains traction, it's very, very different. Because at the end of the day, finance is a much more homogenous, business. There's so many things and products that are doing very, very similar types of things, right? It's not like tech where you can come up like a great idea. There's no one out there. Once you have traction and you've like developed this, software, this app, people are using it. It's entirely different. It's like it's much easier to start in tech software engineering at a young age than it is to start a hedge fund when you're 21, 22.
That sounds entirely different. Well, you need capital, right? And
right.
Capital, and like it's hard to, and people won't give you capital until you have like 10 years of track record.
Yeah. Yeah, exactly.
Whereas it's almost the opposite. Like if you're super sharp, young tech engineer, some genius, and you're like, hey, look, and we have traction, then people will be throwing.
Exactly. Like experts always say, like, you can't teach market experience. All the best investors have 20, 25, 30 years. They've been through multiple market cycles. It's tough to give your money to someone when they haven't even lived through a full business cycle yet. That's just like the general mentality in finance.
So walk me through kind of as you're approaching this realization that you're not going to be able to raise any money, that you're not going to be able to scale this, and then talk to me about how you started the interview process, who you were reaching out to, because at this point you had already graduated, right?
Mm-hmm.
And so like you're kind of like a CEO, semi like of your own thing, which to a lot of people says, oh, you're just unemployed. So tell me a little bit about like how you had those conversations, because this might be really relevant to people who also try to break out on their own and then decide, well, actually, no, maybe I should get some experience. So how did you kind of have those conversations around networking, and how did you even get the interview at Morningstar?
Yeah. Quite honestly, like, at that point, like I told you, I'd spent so much time doing stuff on my own that I kind of like lost focus on my own schoolwork. My grades weren't as good as they were going to be. And obviously, University of Chicago is also really crazy grade deflation, right? It's like the average GPA for a lot of the majors are like below 3.0. And if you don't spend 30 hours studying a week, you're not going to be able to get under the top buy side firms because you won't, meet the GPA filter, which is exactly what happened to me. It turned into like a numbers game. Luckily, Morningstar, I think, obviously was started by a University of Chicago grad. So I think even though my GPA was a little bit lower, they gave me an opportunity to interview. And at this point, I'd sent out 50, to 100, resumes, just like shooting it down a black hole, see whatever I can get. And didn't really get that much back because of that. Obviously the GPA issue, and obviously seemingly like I didn't have a junior internship. It definitely was a risk that I took. Now looking back, I obviously don't regret it.
Yeah.
But
on your resume, did you have like your returns and your strategy that you had been doing? And
okay, I put it in there. I put in my cover letter. That was the most important part, right? I think the cover letter mattered more for me than any other person because of my unique situation. And actually, my interview process through Morningstar was really interesting. They just grilled me on the strategy and the option strategy. That was every single interview. They're like, actually, this is like really, really interesting. They're like, we want you because like we can see you're really, really passionate about the markets. And that's actually to us more important than any sort of GPA that you can get, because they know like this kid wants to be in it for the long haul, right? Yeah. And I think it's unfortunate that there's kind of this GPA filter that a lot of top buy side firms have, but it doesn't mean that you can't make an extra step or two to get to that spot, right? You can still get there. Yeah. You just have to be very, cognizant of your story, your narrative,
deliberate,
and really, right, and very deliberate, and really plan out your path. So, I started at Morningstar. Obviously, they weren't well-known buy-side firm, but still a big name, nonetheless. So that's where I kind of got my first chance, essentially.
Yeah. And data analyst. So, did you have any sort of engineering background? You had a little bit of stats, but, tell me about the learning curve, the skills you needed when you first started there, what they expected of you. Because there was like some portfolio analytics and acquisition. So you were buying portfolios for them? Or
so, the Morningstar's biggest product was Morningstar Direct at the time. I joined Morningstar's, development program, which is kind of a rotational program. Yeah. And that was my first role they put me in. And the reason why they put me in there was because at the time they were trying to improve their derivatives analytics. And they knew that I had experience with options and derivatives. So this was like the first group they put me in. And they had kind of a rotational program where I worked there for like, probably for a year, maybe less than a year or so before I rotated into the more asset management side. But we were essentially acquiring data and client portfolios to put onto our Morningstar Direct platform. It's not that we were actually getting their money. We wanted to get analytics and kind of build that database for derivatives, obviously for future use and for obviously like developing algorithms and stuff like that. So I was really part of their data business, doing a lot of ticketing, answering client questions on analytics, developing the advanced portfolio template with the SEC, which was at the time, the SEC was trying to, create through the NPort ruling, what type of derivative analytics they had to start collecting from asset managers to gain transparency, right? So I did a lot of work on the analytics side, portfolio analytics, like anything that you saw kind of like on the sell side research on Morningstar style boxes, all the analytics they have. I was like in charge of all of that, essentially.
Cool. That's awesome. That's pretty good for your first job at a school.
Yes, it's pretty good. Got lucky they gave me a chance for sure.
And then was pay kind of like more, obviously not like a top hedge fund pay? Was it like mostly base salary, I assume?
Yeah, it's pretty much all base. The pay wasn't good at all. I mean, Morningstar generally, I think the pay was a little bit lower.
Like 70-ish, 60-ish. Like what are we talking here?
At the time, it was like 60. Back like 10 years ago. But also remember, this is also Chicago. Chicago pays me a little bit lower just because like the cost of living is like cut in half. Like
so at this point, what are you thinking to yourself? I'm sure there's people at Chicago that it's like at the top hedge funds are like, oh, I got this bonus, and you're sitting here, you're like, oh, I started my own hedge fund. Like I have chops too. Are you thinking like, hey, I'm going to get there? Are you thinking, hey, let's map out this data, kind of more data asset management career, or what? Or are you?
I didn't really worry about that. I wanted to get into asset management. I had trust in my own skills, my own market knowledge. I understand markets really well at that age. I think relatively to most people, I had confidence. At that point, I actually took my CFA level 1 my senior year of college.
Okay.
And that's also why I potentially got some interviews. It was like, oh, this guy's kind of ahead of the curve. He started taking my CFA early. So I actually did that, my last year of college. And honestly, I think at a very young age, yes, I think it's easy for you to look at your peers and be like, oh, I'm making less money, blah, blah, blah. But that doesn't matter in the long run. Early on in your career, you just got to learn, get the skill sets. The pay will come.
Yeah.
As long as you're passionate about something and you work at it, people will notice it. And if you combine that with good networking, your network will also work for you, right? And what I mean by that is really like be giving of your time with people at work, right? You want to get noticed, treat the people below you as you would above you. I know a lot of people, they just suck up to their directors, they're above you. Don't do that. You got to treat people the same way. It shows a level of maturity, it shows a level of leadership that you're giving about your time. And people will notice that. That's how you get promoted. That's how you get people to speak positively about you, right?
Yeah.
If you are that type of...
Speaking of internal or networking in general, you did make a transition within Morningstar, it looks like, from more like the data side to more an investment analyst side. Can you talk to me about like what the skill sets were different, how you made that transition specifically? Like, was it because you were, building a good reputation on the data side that you were able to make that internal transfer? And then how did you even, I know it can be tricky when you're in a certain group to kind of lateral to another one. How did you do that?
Yes, absolutely. I mean, it was part of the rotational program, so they did expect you to rotate.
That's good.
But, there was obviously huge competition, right? Like everyone wants to rotate from data into like the equity research portion, or rotate from data into like the asset management portion, the buy side asset management arm of Morningstar. So there is that competitive aspect. So this is where like the networking comes in, building a good reputation for yourself, be giving of your time. Like your impact in your role is beyond what you do day to day. Help your employees, have an indirect impact on the company, right? If someone asks you for help, you should be giving to help. At the end of the day, you're all working for the same firm.
Is there a specific example like of a time when you did that?
Yeah, absolutely. If someone, needs help with like a SQL query or something, you should be giving of your time, help them. Like, don't be stingy with your work. At the end of the day, you're working for the same company. People will notice that, hey, this person, not only does he make a direct impact in his role, but he makes an indirect impact on the firm and on the department. And that indirectly affects the bottom line. I think just when you're younger, you have to think bigger picture. Everyone gets stuck in the weeds.
Yeah.
And that reputation builds. My manager saw that, the people in asset management saw that on the investment side. So when I interviewed, people already kind of know your name, right? It's like,
Yeah,
this guy's that he already kind of built a reputation for himself. He's been a huge value add to the company. And this is really how you kind of stand out. It's a huge part of his networking, right? Painting yourself in the right light.
for sure. So
And
this
just
was
like,
this was a
yeah,
rotational program, but it was competitive to get into that specific
exactly.
rotation. So you
Right.
ended up in it was called capital markets and asset allocation group.
Yeah.
Like,
So
tell me
this
about
was,
how your work changed day to day, and like what it sounds like it went from very data heavy to more like what to more obviously investment and analysis stuff like that. And how like so what does that mean day to day?
yeah. So yeah, obviously a lot less on the SQL, a lot less on the coding side, and more obviously with Excel, market research. So Morningstar had a subsidiary called Morningstar Investment Management, and that was their RIA business. They had a lot of target risk portfolios that they would sell, and they also had an advisory business as well, where other firms like let's say TD Ameritrade at the time that when they weren't bought out yet would hire us to give them asset allocation views and tell them how to position their portfolios. So both I had worked in advisory as well as kind of managing Morningstar's asset allocation portfolios, and entirely different work. Did a lot of market research, a lot of asset class level research. So at the time, I was in charge of my sector research for like global consumer discretionary and global technology. And I would essentially model 200 to 300 different asset classes and come up with expected returns over a 10 to 20-year period using a very fundamental contrarian valuation driven approach. So I did a lot of economic research, pretty data intensive, obviously,
What are your
collecting
primary sources? Yeah, where are your primary sources for that data, like to be able to do that?
Bloomberg and FactSet. FactSet was huge. FactSet, they had a lot of really good index level data. So
Okay.
let's say I wanted to model the Japanese tech sector and see whether we wanted to gain exposure to Japanese tech sector. Obviously, at the time, Japan, we wanted to underweight.
Yeah.
Still, probably want to underweight. But you would look at the topics, for example. Topics is the kind of like the S&P topics was kind of the Japan
Yeah.
overall index, but they also have the S&P topics, Japanese tech sector index. And so we look at the history of that index and the fundamentals of that index relative, to its median levels of valuation and seeing is it overvalued, undervalued based off of a bunch of these different fundamental factors like, price to book, price to earnings, price to cyclically adjusted earnings, price to sales,
Yeah.
And really trying to understand what is essentially the median level valuation over time and seeing this. It's essentially a mean reversion model, right?
Yeah. You're basically trying to see what's a relatively out of favor, potentially a deal, and what's overly hyped, and
Right.
what you want to potentially underweight.
Right, exactly. If
Yeah.
we felt like something was, undervalued, a particular index or particular asset class is undervalued, you know, we may want to invest it. We would do more in-depth research, right? Because you still need some sort of a catalyst that's going to bring it back to fair valuation, right? So just because something's undervalued doesn't mean you should buy it. Obviously,
Yeah, I
it
mean,
could
it's
be
an interesting. Yeah,
right,
I mean, there's probably some cyclicality around oil and gas and all this stuff, and like what's the play long term? Like, are there industry trends that are going to be making oil and gas long run? Like looking at long run when there's such like
right,
massive changes happening in the market and battery
yeah,
technology, it kind of makes it like scary just to be like, oh, it's undervalued, go.
yeah. And at
uh,
the time, energy was performing very poorly, and how we modeled the energy sector, at the top down level was very, very different. We wouldn't use price to earnings. Obviously, the earnings were negative. You wouldn't even touch price to cash flow. It was more like you look at price to book, price to sales, relative to the last 20 to 30 years, and really trying to understand when is it going to revert back. And so like energy, for example, at the time was one of those things where we really underweighted for quite a long time.
yeah. So okay, so then you're kind of there for almost 2 years in that new role, and what's your thought process as you're kind of there? Your skills are growing. Why start looking around? You had said to me in another call, like you made a few moves and you kind of knew what firms you wanted to go do, and you didn't talk to that many people. It wasn't like you were just sending your resume everywhere. You kind of had mapped your career. So talk to me about like why go to Schwab next in that investment risk specific role, and then kind of first off, how did you even know what that path was at such a young age, kind of a couple of years out of school.
Yeah. I'll kind of provide some context in terms of time, right? I think I graduated in a time where, the industry and financial industry was really changing,
Mm-hmm.
like becoming more, less focused on Excel, moving more towards Python. I think
Yep.
Python really took off over the last, 3 to 5 years. And at the time, you know, fundamental investing, stock picking was becoming less and less of a thing. It's becoming more of like kind of the terms of like the dinosaur age, right?
Yeah.
And
Active managers.
right. And
Move.
active managers at the time, obviously active managers are doing a lot better now, given sector dispersion. There's a recession, people are looking for active managers, but passive was like huge at that time. And also quantitative investing was building. Obviously, there's a ton more data, better technology, machine learning, able to handle large data sets. The way people were investing was very, very different. In my mind, I wanted to change with the industry. For the longest time, I wanted to go into portfolio management, go into equity research. So at this time, I was already kind of thinking about maybe you want to like move more towards the quantitative space.
Mm-hmm.
I hadn't really, taken action. I'd worked at, kind of the investment management arm for roughly 2 years now. And then one day, my first manager for my data role, reached out to me and he said he was actually moving over to Schwab. He was taking a huge, the managing director position at Schwab, and told me that, he would like me to apply and potentially join them. And he knew that, I worked with him for like a year in my first role. He's actually my first manager ever. Great dude. He always looked after me. He always tried to, he always like had me in mind, right? He knew that I wanted to stay in a markets role, and he was moving into a markets role at Schwab. And he was like, hey, like give it a shot. I know that, you always wanted to kind of stay in markets, and I think this would be a good role for you. And it was kind of more of a quantitative role, and I had already kind of started thinking about it. It just happened to work out. And so yeah, I interviewed, and that's how I essentially moved. It's just a combination of me already thinking about going more to the quantitative space, given where the industry is moving, and
That was
really
the
learning
move.
more about factor models.
And that was a move
Um,
here to West Coast.
right. Actually, I was staying in Chicago, actually.
Oh,
Schwab
okay.
at the time, they were opening their first branch in Chicago. And so
Okay.
I was one of the first employees in the Chicago office for Schwab.
Was your boss there too?
Yeah, he's based in Chicago. His family's there. He's still there.
Got it.
And yeah, I hadn't moved into San Francisco until maybe around the pandemic.
Yeah.
And then I moved to the San Francisco office for Schwab.
So tell me about like what is even a senior manager of investment risk? What does that even mean? Like what's the day to day like? How is it different from what you were doing before at Morningstar?
Yeah, absolutely. The way I started looking at strategies is very, very different. You start looking at cross-sectional bets in the portfolios. Like before, I would just look at individual stocks, aggregate them bottoms up at the index level, see what the fundamental valuation is, what are the catalysts, working in Excel. Really, really little work on risk factors, right? Once you move to investment risk, when you start evaluating fundamental managers through the risk lens, it becomes an entire different beast, right? Because a lot of these fundamental managers, they're not very familiar with risk models. Sometimes a lot of these managers may not even be really familiar with the style bets they're making. They don't pay that close of attention to it. Like sometimes they manage the risk at the individual stock level. But when it gets aggregated up to the portfolio level, they may realize, oh, they're actually very overweight, volatility, or very overweight, you know, reversal, or underweight profitability, and they didn't necessarily intend that. And that can have outsized impacts on your attribution and on the performance of your fund if a certain factor moves significantly in one direction from like a market regime change or something.
Like it did in
So
2020.
yeah, exactly.
2020, 2021, if people were underweight growth, they were in
Right.
trouble.
So the way I started to look at the markets and managing assets, it went through like a completely changed it to completely through a different lens.
Yeah.
And it became really, really useful to really have, that knowledge of both the fundamental aspect, but also the quantitative aspect of how factors actually, factors explain the vast majority of returns. Everyone knows that, generating alpha is extremely tough, generating alpha more than the fees they charge. And so really understanding factor moves and under the hood.
For people who
Really,
don't know what factor moves, can you explain to the listeners what that means?
yeah, absolutely. So, factors is essentially, high level characteristics that you can describe a stock, right? Some stocks are going to have more value exposure, they're going to have more growth exposure, they have more profitability exposure. right? So let's say, for example, a profitability factor. There's many different ways you can measure profitability. Obviously you can look at margins, like the way that, people model profitability might be profit margins. So you look at, which companies have the highest profit margins, you'd rank them, from top to bottom, all the different stocks. And you could almost like create a factor index weighted by profit margins, right? And that is essentially almost your profitability factor, where you can see, oh, if profitability is now very in favor because we're entering a recession, people want strong balance sheets, you'll see the profitability, essentially the factor index, outperform the S&P 500.
Or get too overweight, or get too hyped.
Right, exactly.
Underweight growth.
Yep. So you're slicing and dicing the market into these different risk factors that you think explain the returns of a particular stock.
It's interesting. Yeah, I think, just how everything has shifted so crazy from 2019 to today, 2023. These are the last three-ish years, well, since the pandemic, really, from like crazy bull to suddenly a dramatic drop to an explosion, really an explosion up with liquidity, to suddenly everything coming out of favor and interest rates exploding with inflation, to everything just literally being just flipped on its head and reversed.
Right.
And super fascinating. So yeah, I mean, I'm sure factors were where, I mean, I'd be curious to hear like what you guys were saying in 2021 when growth was super, before things started falling apart. Stocks with no profitability. I'd be curious if you guys were banging the table, like, might want to rotate into some more value at this stage, or
It's funny because at Morningstar, the longest time, like, we tried to underweight growth. We thought that there's going to be a reversal at the time. This was 2016, 2017. And it really hurt the performance. It's really hard to time the market. At some point, obviously, growth did reverse. Now we're in 2023, but man, you're underperforming for like 5 or 6 years, right?
Yeah.
Continuously, underweighting that aspect. I think it's just the aspect of like playing both sides. You should definitely start trimming. You may not have to be super aggressive trying to time the market, but like a lot of the managers, like we were talking to at Schwab during the time, they were so growth heavy. Like everyone was overweight growth and overweight momentum too. And eventually, obviously, it broke down with the whole pandemic.
I was overweight. I mean, especially I was, and I was probably I was pretty balanced throughout the whole bull run. But then what happened was in the crash, tech, it made a lot of sense to just pile into tech, where that's the one, Slack, all these other ones,
right.
Peloton, all these things. It made a lot of sense, right? So you could go into there pretty confident these are good businesses, they're growing, they're exploding actually in growth. So it made a lot of sense. But then I think it was the non-rotate. A lot of people got caught with too much of that factor of growth-oriented factors, but myself included. So like the last 2 years, luckily I never go too heavy. I always have a pretty balanced portfolio, so I'm okay. But I know some people who go really aggressive or trade on leverage, and it got ugly for the last year or two. So
now you mentioned, it's actually really interesting because you could still invest in growth, but in like a safer way, right? There's dividend growth strategies. Like dividend is also one of the really big risk factors in models. And there's a period of time, I think, 2017 to 2020ish, where dividend factor really outperformed. And I think a lot of recommendations to manager was like, actually, you could invest in the dividend factor in stocks that have pretty good dividend growth, and get exposure to that growth, but also be protected on the downside. The reason why, if you think about, at the time, why did dividend perform so well? It's because interest rates were so low, right? Any sort of investor that was looking for yield, looking for stable cash flows, they wouldn't put it in like the 10-year yield. At one point, the 10-year yield was below the S&P 500 yield. Yeah, it's like you might as well, you get better yield from investing in the S&P 500 than you did from putting in a 10-year treasury.
Yeah.
So that's why, for investors that were looking at yield, they moved away from fixed income. They started coming into equities because interest rates are so low for so long.
Yeah.
And it caught a lot of investors off guard. So a lot of them that were underweight dividend because they were just buying growth in companies that obviously like didn't have any dividends, they just reinvest their cash into their businesses.
Yeah.
They got screwed. They were underweight dividend, and the dividend yield factor, really outperformed for a couple years, 3 years, because of the substitution effect with fixed income.
Yeah.
And now you look at now, actually, if you had put your money into, dividend growth strategy, like one example is DGRO, which is, the iShares dividend growth. Since the drop in last year, it's been pretty much flat. The total return, including dividends, has been positive, actually. If you
Yeah.
had put your money into dividend growth, mid last year, early last year, you'd be totally fine. So there's ways to get a balance of both flavors,
Yeah.
to really like manage your, assets from a diversified standpoint.
For sure. Yeah. It's really fascinating. So, okay. So you're kind of start this job at, it was Schwab, right? So you're saying
Yeah.
you're there and kind of doing some, more of these models and trying to, identify factors and, but like your day to day, you're working with your boss, but it's an internal role, or is it something where you're actually talking to clients and helping them, helping them?
I wore a lot of different hats. It was internal and external.
Okay.
The internal aspect of, because Schwab also had their own active quant strategies. So I would have day-to-day communications with portfolio managers, do a lot of quantitative research for them, and really provide like recommendations on, where they may be taking too much risk, maybe where they're taking too little risk. And like,
What's the most important skill you had? Python?
market knowledge.
Market
I
knowledge.
think
Okay.
there are too many people that are in the quant space now that lack that market sense, that lack that market knowledge. And I think that is why a lot of portfolio managers don't really like taking advice from
And so
quantitative.
when you say market knowledge, you think obviously your economics degree helped in knowing macro really well,
Mhm.
being able to talk
Right.
about broad, general macroeconomic trends.
Right.
Do you agree? Is that like probably where it
Yes.
helped you the most because you could speak intelligently on that?
Right. I think that's where it helps you be able to connect with the portfolio managers. Because all these portfolio managers are not necessarily the most quantitative. They're not doing the quantitative research. So if you can put a narrative behind the words, it
Yeah.
makes it a lot easier for them to understand. So I'll give you an example, right?
Yeah.
I was looking at the time, healthcare. I was looking at kind of the macro risk models, and one of the factors was essentially the sensitivity of the healthcare relative to economic growth, and this factor was proxied using the industrial production index. And you notice if you looked at the factor and the exposure of the healthcare sector relative to the economic factor of industrial production, the exposure had essentially doubled over the last 15 years. So essentially what that means is healthcare is becoming less and less defensive, large cap healthcare.
Mm.
That's what came through the numbers and came through the risk models. But what the managers want to know is, why is that happening from a qualitative aspect, right? The risk models are not always right. You can't just take the numbers for what it is. You need to like put some sort of narrative or a story behind it to make it more of a convincing argument. Now, the reason why that
all
is
becoming retail, they're all becoming consumer like oriented companies.
yeah, and
Walgreens,
at the time,
CVS, yeah.
at the time, and I'm sure you've heard about it, right? The industry has changed significantly. Back then, all the large pharma companies, biotech companies did a lot of their own R&D.
Mm.
Nowadays, in the late 2010s, they don't do R&D anymore. They let the small caps and the new companies do it, and they just acquire them.
Mm-hmm.
What this means is they're much less insulated. Now these larger, they're much less insulated to changes in the economy, because now they're much more focused on commercialization of drugs, much more focused on manufacturing of drugs.
Mm-hmm.
So the revenue mix completely changed, and it made the whole large cap healthcare less defensive. Now, this was a story.
I don't understand that. So like you're saying that because they became more acquisitive of small, they weren't doing the R&D, why would that make them more susceptible to less defensive? They're still selling drugs, you're still manufacturing drugs. Drugs still seem to be a pretty inelastic good, right? Or like pretty inelastic. So like what part of that, I guess, makes it less defensive? Because it's become more like commercialized in the sense of like it's more of like almost like drugs that mix became drugs that are not like needed for like critical illness, but more like cosmetics and other stuff, or
Right, it's just like tied to like industrial production. It's tied to like a lot of
okay.
like
Got it. It was a more of a became more of a
increased
manufacturing
costs, right?
business rather than
Right. Exactly. So like if you're more at the whim of increased input costs, like yes, it's still defensive,
Yeah.
people are still going to be purchasing drugs, but your cost of producing those drugs are going to start increasing, and you're going to be more susceptible to that because now a larger of your revenue mix is going to be in manufacturing, and even like advertising too.
Yeah.
Now they spend a lot of money on advertising these drugs, and advertising is also very cyclical. The cost of advertising is also very cyclical. They're more exposed to these areas, whereas back then in R&D, R&D is like it's much more defensive in the sense that you're you can like license out drugs that you're doing research on,
Hmm.
and also like the acquisition aspect is also very cyclical. If you're focusing more on M&A, your ability to acquire smaller companies puts you in a much more cyclical business, right? Because
Yeah.
if there's lack of funding and we're about to hit a recession,
Yeah.
your cost of financing is going to increase, and your acquisition cost of smaller companies is also going to increase, which is going to hit your bottom line, which also makes large caps less defensive. So that's also another aspect of it, is the M&A aspect is cyclical in itself.
That's interesting. Yeah, it's interesting to think of that. And so, okay, cool. Good example. So yeah, you're there for 2.5 years. What then what? And why the move?
I just felt like I wanted to move on, and I personally, I think at the time, like I wanted to work for, I wanted to learn more. I felt like I was my growth after the 3 year mark. I wasn't learning as much anymore. I
Mhm.
felt like I was kind of like doing the same thing over and over again, and my team was pretty small. I wanted to like learn from someone new, learn from a different firm. I wanted to get an obviously more reputable firm with better talent. And so I started applying for, like you said, like top buy side firms, right? I was very, specific in who I wanted to target and what I was looking for. And at the time, BlackRock was, at the top of my list for a number of reasons. One, they're almost like the Google of finance. They have the best technology of any financial firm in the industry. That's what separates them. Like at the time when I was, covering products at Schwab, I was also kind of covering a little bit of the passive products at Schwab too. And when we did competitor analysis, I'd always noticed iShares always track tighter to the benchmarks, and they almost always slightly beat the benchmarks, even in the passive space. Always. I never really understood why, for so many years, and I wanted to know. Like, I just knew BlackRock was number one, and after interviewing with the people, I think just the level of talent there, the caliber of people on average, so much more. And one of the best ways to go with your career is your network and also the people you learn from. It's not just about the role itself. I
Yeah.
want to surround myself with people that had the same level of motivation, at the same level of you know passion for markets. And I felt that the culture at BlackRock had that, and it was something that a lot of firms I feel like misses.
Hmm.
And the technology aspect, and yeah, and obviously just a wide range of products. There's just so many more products I can learn about and learn from. And
You
so,
were looking to do something similar to what you were doing at
right.
Schwab, just at a different firm. So tell me how has it been?
It's been very different. It's not exactly what I expected.
Yeah. Tell me why.
You know,
'Cause I think
maybe,
that's always hard because like before you make the jump, you think something, but then you're
mhm,
used to your manager, how they work, the way that firm works, and you were there for almost 3 years, and then suddenly you're in a new role, which is supposed to be similar. But tell me how it was different and why it was surprising.
I think the most surprising part was how much research and quantitative research goes into managing a passive product, in the ETF space. At the time, I'd considered, actually, I'd interviewed with, you know, the active systematic team and the active fundamental team at BlackRock. I also interviewed with, kind of, the beta team, which is that's what they call it there for the ETFs. Beta, essentially, you're looking at the market level risk because you're not necessarily making active bets.
Yeah.
And it was interesting to me because I wanted to try something new. And like I told you, I always knew like iShares is obviously a huge growing business, huge money going into passive. Um, a lot of it is because a lot of these multi-asset products have iShares as underlying, funds in their portfolios. And I always wanted to be on the right side of the changes in the industry. And that's what kind of drew me to it. And then what was so fascinating about it was the product development in the passive space, developing these new strategies. It's almost like there's so much product innovation in this space, and the reason why there's so much growth, is because we're doing all this kind of like developing these new strategies, generating alpha on an absolute return basis, while also continuously lowering the fees and lowering the costs for investors, right? So many investors are talking about, oh, fees of active funds are too high, blah, blah, which is entirely true because, a lot of most managers, obviously, as people know, don't beat the benchmarks after fees. They're not, whatever they charge, the cost, they're not able to generate alpha over the long term to meet those costs. And so the value proposition for active just wasn't really there. And I could obviously see that's why there was such a huge growth in the ETF space. Yeah. Not only that, as you know, ETFs also are highly tax efficient vehicles. They actually exist in two places, in the secondary market and the primary market. I think a lot of people don't know this. Where if you buy an ETF, you're actually just buying the shares of the ETF. You're not actually necessarily buying the underlying stocks within that ETF. And the reason why ETFs have such great liquidity and it trades like a stock is because there's a second layer called the primary market, where there's these APs or authorized participants that almost act as liquidity providers, and they hold inventory of stocks, right? If let's say, a retail investor wants to buy, a block of retail investors wants to buy a particular ETF, the ETF order goes to authorized participant. The AP holds obviously a bunch of stocks inventory, almost kind of like market makers. And then we create an ETF share, BlackRock does, right? We give the AP the ETF shares, and they give us the basket of stocks. So if you notice this exchange, we're never selling or buying the stocks. They're all just exchanging of baskets of stocks, which is why there's no taxable event.
Yeah.
And that's why ETFs are so tax efficient. And that's why they pay way less taxes than mutual funds. And
you're able to rebalance without having to go in and out, right? It's you're getting
exactly.
You're getting rebalanced. But so, question I have for you that I think I've heard it a few times. So, like, as trillions and trillions and trillions of more dollars flow into these passive funds, do you see there being risk around specific concentration? Like, if there's too many in the standard S&P 500 shares, right? So, like, being in the S&P 500 or not, isn't that single-handedly like driving the value of the business or the market cap of that business way up, just because there's so much passive that has to track that index? Like, so like just that decision of being whoever decides, whatever companies are in the S&P 500 or the Dow or whatever it is, whatever index you're tracking to, doesn't that have like an outsized, or couldn't that eventually have a really outsized impact on the valuation of the actual company? Because there's
yes.
And
it absolutely does.
Aren't we already seeing that? Like, is that something where, like, as a factor, like another factor of being part of an index, you could almost say it's overweighting. That's probably why there's so many additional strategies you guys are coming out with and more breadth to these baskets, because you shouldn't be putting it all in the one basket. But like, what's your thought on that? Because there is just so much flowing to the passives. It's like, to me, like, is there systemic risk around, some of these larger baskets that are just now accumulating? And it's not just BlackRock; it's all the others that also have the same 500 or the same 30 stocks. What's your thought? Any thoughts on that?
It definitely generates more volatility in the market, especially because so many of these, let's say, there's like Vanguard, State Street, right?
Yeah,
BlackRock, all these index providers, they all have like your typical S&P 500 index, right? So that's why, like, now more so than ever, all these companies are trying to get into the index, because they know that if you get your company into the S&P 500 index, it's automatically going to pump up your stock. There's more eyes on it. There's more demand for it.
Yeah. So
now more so than
by how much? So you think it's like a 20% premium, like from being the 501st company to being the 500th company? Like, does your stock like get a 20% market cap boost? Is it like worth billions of dollars just to be in that index? Probably, right?
I think it does, but also,
like, remember Tesla got added or something, and it was like this big deal. Like, or was it Tesla?
Yeah.
Yeah.
I think Tesla's added, but I think for the longest time it wasn't added because the S&P had certain rules around how many years of profitability you needed in order to get in there.
Right.
So depending on the index methodology and what you need to meet in order to get into those indexes. But I mean, like you said, that's $1 million question. I think there's been a lot of talk on CNBC, just headlines talking about, oh, are we in like a passive investing bubble, right?
Right.
Now, that's entirely true. That's $1 million question. Like, I'm not going to put my opinion out saying that we are in a bubble or not. It's obviously a very difficult question to answer, but the vast majority of money that's actually in passive is going to be in like public pension funds. It's going to be in retirement space, right? In order for a bubble to pop, there has to be panic. People have to pull money out.
Mhm.
But if you think about it, retirement, it's all locked. People can't really pull it out. So people are saying that even though there is a premium to these names are in the passive space, the premium might actually stay there for decades. So people are kind of talking about there's thoughts, experts are saying that potentially, when the baby boomers start pulling money out at retirement age, right, it may lead to a large decline in a lot of these large cap names because of the selling of these large cap names and these indexes in the retirement funds.
I'd just be curious
Um,
to hear, like, or just to think about that, like that whole factor, like the demographic factor moves, because I think that's super interesting, right? Like in terms of these passive strategies, they're exploding in growth. I mean, maybe the explosion of growth and the money moving in would offset those boomers pulling it out, so that it's kind of a wash. Who knows? But like maybe not.
right.
Maybe they're going to continue. Maybe the premium is going to continue over the next 20, 30 years, where it gets to a point where maybe it's a bubble that just gradually, very slowly builds,
Mm-hmm.
and then it becomes really scary.
Right.
uh,
Honestly, I don't know. I mean, I think the passive space, I think there's obviously, in my mind, there's still more positives than negatives.
yeah,
It's definitely
I
helped
agree.
democratize investing.
Yeah,
Yeah.
I agree 100%. And I think there is some solace in the sense of not everyone just puts in an S&P 500 index. So like there's a lot of money going elsewhere.
Right. I think the space is evolving pretty quickly. I think there are, mitigating factors, right? In the sense that like all the vanilla, ETFs have already come out already. Now there's a
Yeah,
lot more bespoke products. Like we have like an iShares like Saudi Arabia ETF, an iShares Poland ETF.
yeah.
Like we're offering so many products now with
It's even
different.
short based
Mhm.
ones, right? There's like
Right.
vol. There's all these other ones that
Mhm.
you know allow people to get different
Exposures. Yeah.
stuff. So
Yeah, I think that has a lot of mitigating effects for sure. And right now, like BlackRock, for example, the primary focus is to come up with a lot of these more exotic products.
yeah,
And I think a lot more firms are following that footstep because there's a lot of market share to be grabbed. And as more of these products come out, there's also a shift, from kind of the larger index funds and just say like the S&P 500s. And really, if you think about it, the active investing and the onus is really put on the retail investor, right? Now you're not buying like an active manager who's actively managing S&P 500 benchmark. Now it's up to the retail investor to decide, I want to allocate my portfolio to like a European ETF or like a Chinese technology ETF. So
yeah.
the onus is going to, I think, put more on the retail investor. I don't know, how that's really going to, shape the long-term investing landscape. Because at the end of the day, like, comes down to financial literacy, right? And I think I think retail investors, it's everyone's, investing is like so heterogeneous. Everyone has different views of the world.
Yeah.
There's going to be just a lot of demands for all these different bespoke products, and I think that in general, the products in the passive space will become more and more diversified over time.
Yeah.
So I don't necessarily think, I don't know how big that bubble is going to be, or how worried I'd necessarily be, because I do see a lot of innovation in the space where there's a lot of different
There's money
products.
flowing not just to the same names everywhere.
Exactly.
Yeah.
Yeah. And it's another example is like the ESG space. We have a lot of these ESG passive products now, where a lot of we develop these ESG indexes, where we have to develop a methodology for what stocks can make it into this ESG index, right? They have to maybe meet some sort of an MSCI ESG score. Like they may meet some sort of a baseline screen, like, they cannot be involved in like, fossil fuel production or manufacturing, cannot be involved in like tobacco or like, or stuff like, child labor or, like sex trafficking. There's a lot of these like
Yeah.
ESG, factors that are putting more focus on like companies that are much more like conscious of like obviously society and like they're much more conscious of like making a positive impact on society. So like this is putting more money and flows into ESG names, which I think is great.
Awesome.
It's not just all about profits. It's about putting money in and creating this a more sustainable future for us to live in.
It's great. Well, Scott, out of all your moves and all your things, what would you kind of leave listeners with in terms of final words of wisdom?
I mean, I'll just say like, I mean, I think a lot of times people in finance, they really go after money or whatever it is. Like, follow your passion first and foremost. Like, I didn't know I would be.
Has the money arrived? Are you making 300-400-ish?
Yeah, it's good. It's good.
$3 million a year? No, just kidding.
Definitely not trailing my peers as I did my first role. But definitely chase your passions, focus on skills. Because if you develop the right skills, they'll show up in interviews, they'll show up through your resume, and people will want to hire you.
Yeah.
Don't be discouraged just because like you sent out 100 resumes and you got like one interview. I totally understand it is discouraging, and I think I've been through that. A lot of people have been through that, but it doesn't mean that you can't get to where you want to get. And you can still have a very, very fulfilling career. So just like, think long term, like your career is 20, 30 years. Just because you aren't where you are right now, like just put your head down and just, work harder. It'll definitely come. And, network properly, as I said, like I think meeting people is the easy part. The harder part is, portraying yourself in the right way to the right people. Otherwise, you're going to be finding yourself introducing yourself to people one at a time. You want to make your network work for you, right? That's how you build reputation over time, and that's how you grow your career. And the same thing with developing skills. You got to think very long term. I think, your career's going to be long. Like I feel like I've been in finance for a long time, but man, I'm probably not halfway done with my career.
Your network working for you is kind of like as you're kind of approaching the end of a call or end of a coffee chat, it's almost like, well, is there anyone else you think I could talk with? That kind of thing. And then obviously keeping in touch with them. And so that they feel a connection with you. They want to help you because they mentored you and they want to see you succeed. So I think that's people underestimate that power of that because why are they going to want to help me? I can't do anything for them. Well, they probably maybe see themselves in you. They want to help. They feel good about themselves giving back. That's value. So
not only that, it's just also like, be personable. I think a lot of people say that, but what does that exactly mean? Like, when you work, people don't want to just talk about work. They want to know that you're a fun person outside of work. You have a lot of energy. You're an interesting person. At the end of the day, you're going to be spending 40 plus hours with this person, day in and day out.
Hilarious because we had a top trending content on the forums this past week, which was like, how can you be interesting? I'm so boring because all I do is work. But there was some good stuff there. Yeah, I try to have these at least outside of work. But listen, Scott, we'll end it there. Thanks so much for joining and sharing your story. Really appreciate it.
Yeah, no problem. Yeah, thanks for having me. It was a great time.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, patrick@wallstreetoasis.com. Until next time.